Okay, we are live, but we have a new link. So I'm gonna need to share that link. So give me a minute to
No worries.
share it with everyone. All right, just sharing it. You can share this link with folks too if you want.
Thank you.
Oops, I messed up that graphic. Okay. All right, it's been shared around. I think we can get started. You guys ready to go?
Let's go.
Let's do it.
All right, good to meet you guys. Hello, everyone. Welcome to DeFi Nation. Today we have the Ratio Finance team here with an AMA. So I'll let you guys give a quick introduction to yourself, and then we'll kick things off.
Great. Shimon, you want to go ahead?
Yeah, sure. So my name's Shimon, one of the co-founders of Ratio Finance. Met Sam about 4 years ago. We've been working together on various blockchain or crypto projects since then. Got inspired to start Ratio after we started learning more about DeFi about a year ago now. Sam and I were working at an early stage VC company where we were helping to develop an algorithm that would assess the viability of early stage ventures. And on another venture, I got invited to speak at the Ethereum Community Conference in, I think that was 2020. Anyways, got invited to like a DeFi after party, met a lot of the big players there, put DeFi on my radar. And then I started talking to Sam about decentralized finance. And yeah, we just started kind of taking a look at both the risks and the opportunities there, addressing some of the inefficiencies, but also taking full advantage of this new technology. And yeah, I'll let Sam go.
Nice. Yeah, thanks, Shimon. So my name is Sam. My background is in international business and finance. Blockchain and crypto kind of came on my radar during the last year of my studies. That's around the time I met Shimon as well. I ended up writing my thesis around blockchain and potential regulations that the central banks in Europe would take around this, which really got me interested on kind of the mechanics of blockchain and how it can be used to make traditional financial systems more efficient. And this was kind of before DeFi was really, a household name in the crypto industry. So it was interesting to see the synergies that existed and that could be formed. From there, we started working on some other projects that were not DeFi or blockchain related, or a bit blockchain related, but not necessarily super crypto heavy. But yeah, then obviously the crypto industry kept growing and growing. And then after a time, it just really made sense, given my traditional financial background and Shimon's blockchain background, to kind of combine these two things. And I think it was a great opportunity for us to really use our skill sets to our full advantage and try out these new things that were being created. It's super exciting, seeing all these traditional financial mechanisms being uprooted by these new innovative DeFi protocols. The one thing that we noticed right away is that a lot of DeFi ideas are still very similar to traditional financial principles, but they weren't necessarily being included, which in turn made a lot of the DeFi stuff more risky, which is why our real focus became on de-risking DeFi. How do we take these traditional financial principles and risk assessment metrics that have been around for hundreds of years, and tried and tested in the open market for forever, and apply that to DeFi to really make DeFi a safe space for both new and experienced investors alike. And that's kind of where we are today.
Cool. So could you guys maybe give TLDR on what Ratio Finance is and what you're building?
Yeah, absolutely. So Ratio is a collateralized deposition protocol on Solana. What we do is we take the LP tokens that users have, redeploy them into the corresponding yield farms, and in turn, users can mint USDR, which is a stablecoin, against that locked up position. Users will continue to gain yield, so it's kind of like a self-paying loan. We took a lot of principles and brought a lot of inspiration from protocols like Alchemix on Ethereum. But the biggest difference between us and every single other lending protocol is the quantitative risk assessment that we do on those underlying assets, and actually displaying that risk back to the user so they can make informed decisions about the positions that they're taking. We have a lot of strong traditional financial engineers on board that are really focused on discussing and assessing these assets that we're using and making sure that the liquidation and collateralization ratios are actually dynamic and reflective of the nature of the risk of those assets. Because it's interesting, a lot of assets have APRs that don't necessarily include how risky the actual asset is. So you can have a really high APR, for example, and the asset won't necessarily be that risky. And then there's others that have a really low APR, but the pool is actually really risky. And this kind of imbalance leads to a lot of value not being captured. So we really want users to be able to make the best decisions for them and enter the vaults that have the best correspondence to the user's risk appetite, but also what value they're looking for out of the system. And that's where we come in.
Interesting. So you kind of have like a MakerDAO style vaults where you can put up collateral, and in this case, it sounds like you're focusing on LP tokens rather than the underlying assets directly. And then you have that Alchemix pay back your loan mechanic, and you're doing it all in Solana. Shimon, did you build anything on Ethereum before building on Solana, or what's your kind of trajectory to getting onto Solana?
Yeah, that's a great question. So my background's really in game theory and token economics. And from that perspective, I have worked on Ethereum projects in the past. But the thing about DeFi is that it really does need the right infrastructure to facilitate the type of transactions that can lead to actually novel financial products. And while I do think that some of the most novel leadership and thought experimentation in both decentralized governance, finance, politics, art, I do think that's still living on Ethereum. And I know that there's layer twos that are addressing, the scalability trilemma, et cetera. But the thing about Solana is that it has such a DeFi focus right now, and it's built from the ground up in such a way that really facilitates collaboration between different protocols. And also, since we've been working with Solana founders closely, we've noticed that a lot of the other Solana founders kind of have this razor focus on building and shipping better products, as well as supporting each other wherever it makes sense. So definitely think Ethereum has a lot going on, and there's a lot for us to learn from it. But for our particular product, which is focused on working with a lot of different protocols and accepting an evolving set of types of collateral as our risk assessment increases, it really made sense for us to build on Solana.
So Sam, you mentioned that there's some kind of dynamic parameters that you guys are using in order to adjust the collateralization ratio and measure the risk. Can you share a little bit more about what metrics you guys are using and looking at?
Yeah, I mean, this is a bit tricky, because obviously we don't want to fully display this yet. I'll just say that, it's all very traditional focused. So what we've done is a lot of the traditional principles that are using credit risk modeling and credit risk assessment in particular, we've kind of translated that into the DeFi equivalent terms. And those are the key areas that we're looking at. Obviously there's some things that we do account for that are a bit nuanced in DeFi, such as TVL, that kind of stuff, without giving too much away. But yeah, it's obviously we don't want to get too into it, but eventually, a lot of these things will become more open source and allow users to actually be able to make some adjustments to the algorithms as well. But initially, given how strong our team is with regards to credit risk modeling and risk modeling in general, we've really done a lot of back testing, make sure that these algorithms hold up over time.
So are you looking at things like constructing a volatility index, looking at like the gamma of the LP positions, like that sort of thing?
Yeah, that's pretty close. A lot of volatility stuff in particular, but obviously there's a couple of other variables that are very important with regards to liquidation as well. And we actually had a really great conversation with MakerDAO, the guys on their risk team. They were super open with us about how they've been assessing it. So it was pretty interesting to see that where their internal risk metric team, where their head is at, is pretty close to where our heads are at. Although we do like to be a bit more quantitative. One thing that's kind of interesting to note with a lot of protocols that we've spoken to, we asked them like, oh, okay, like how did you, kind of calculate this or that? And they're like, yeah, we just kind of guessed, very qualitative. And that really surprised us. Given how traditional our backgrounds are, that's not really something that you do, right? You don't just kind of guess, especially when there's so much money on the line in a lot of these protocols, hundreds of millions of TVL. That made me feel a bit, nervous about that, and this isn't just a Solana thing, an ETH thing, whatever, but that's why we're really trying to focus on making sure that everything that we do is statistically sound, and we really put it through the ringer, to make sure that we have the safest protocol as well with the rest of all of our algorithms.
Got it. Yeah, how are you approaching liquidations? I seared in my memory is MakerDAO's Black Thursday event where there was basically zero bids on the liquidation side, and things got a little bit messy for a little bit. So yeah, what are you guys doing on that side? Especially since you're putting in LP tokens, so it's not like there's a market for LP tokens. You have to unwind them and then maybe liquidate the assets or something like that. How does that look for you?
Yeah, that's a really good question. In terms of other protocols that have liquidation, most of them rely in one shape or another on external liquidators. So obviously with Maker, that's bidders. On things like Mango, there's external liquidators. And there's also protocols like LIQ on Solana as well, which are offering liquidation services. So one of the things that we're also really focused on is creating an in-house liquidation engine, as well as working with people like Jupiter to enhance the liquidation process. Jupiter's an aggregator on Solana from the Mercurial team as well. Great guys. But the point is that building on Solana allows us to experiment more with more efficient forms of liquidation, as well as risk assessment for different types of collateral in real time, which means that also liquidation events, depending on riskier types of assets, may also be volatile. So we're really taking this approach where we want to start with safer forms of LP and progress into riskier ones. And as we do this, open up governance to help shape the future of how we assess different types of collateral.
Okay, that's pretty interesting. I actually didn't realize that there was like a liquidation protocol on Solana. That's a very useful service. Is that built on Serum, by the way, or is that separate?
It's going to be built on an AMM that's built on top of Serum, most likely.
Got it. Okay, that's pretty cool. Yeah, is there like has there been like a big difference from like a technical perspective when building on Solana versus it's kind of a newer thing over the past year versus things that you've been involved with in the past?
Yeah, totally. For any developer out there, if you want to get a job, learn Anchor or learn Rust, because the thing is, quality developers are much harder to find because it is a newer programming language. At the same time, I feel like it's a really exciting new playground for people that are familiar, especially with DeFi primitives. And programming languages like Anchor, their syntax is quite similar to Solidity. So one of the things that we wish we had learned earlier in our development process was to use Anchor instead of just Rust. We actually wasted a few months of development before realizing that if we recoded everything in Anchor, it would increase the interoperability between us and other protocols that are being built on top of Solana, like 100 times. And the ease of integration will go through the roof. So now pretty much every Solana team that we know, they're all looking for talented Rust devs, even if you can never have enough in how competitive the landscape is. And the other thing that we know is if you're going to learn a component of Rust, it's important to focus on Anchor, and that other protocols that are building on just Rust that are considering building on Solana, check out Anchor as well.
Got it. Let's talk a little bit about like what an end user can do using Ratio. Like, what does this enable?
So Ratio is a governance coin that's quite similar in a lot of ways to tokens like Compound, or even from a certain perspective, Curve or Convex, because what they essentially allow you to do is have an influence on how the risk of different types of LP are assessed, and therefore what types of LP can be accepted on the protocol. And also things like updating types of collateral, updating oracles, all these types of security measures are, with a council, of course, and through delegation, baked into governance. So participating in governance gives you the opportunity to build upon a really robust and powerful risk assessment framework that we think will become foundational in the future of not just DeFi, but open finance. So we really do see ourselves as building that kind of DeFi open finance risk assessment primitive. And if you believe that that's an important thing, then that's why you would want to participate in Ratio governance. So that's what the ratio token does. But the real heart of ratio is, of course, USDR, which is our collateralized debt position. And, what we're doing essentially is we're taking on various types of yield-bearing collateral, bundling that into a dollar form of debt. And as a form of collateral to be used in different, DeFi products or even open finance products, being backed by yield-bearing collateral is already a safer bet, especially when we have risk assessment built in from the ground up. So that's kind of like the heart of, the ratio token and the use case in terms of the CDP. With that being said, our governance model is, very similar to Compound. We're right now, talking to some of the players in the Tribeca DAO, which is recently on Solana, which takes Compound style governance and allows Solana projects to implement it easily. Right now, Solana projects have tended to be more centralized, and that's also because of the way that, or rather the limitations of the SPL library in terms of what you can do for governance. And, this tool set, Tribeca, basically allows you to bring a modular form of Compound governance, including things like, VE tokens that accumulate voting power very easily. So we're quite excited about that. And in a way, we're glad that we've had some hiccups to wait for this type of tooling to come out so that we can make governance a more important part of what we're doing from the ground up, which of course helps us build a stronger community.
So one thing that really excited me when I first heard about this, I'm looking at different protocols on Solana and kind of, how can you yield farm? How can you, either maintain your existing positions or be kind of like delta neutral in the market and put your assets to work to not only earn the yield from the fees of the liquidity provision, but also from the tokens that are kind of rewarded as a result. And then once you find something that you like, then the next logical step is like, all right, well, how much leverage can I get on this? Especially if you found a delta neutral strategy. So the thing that really excited me about this was like, hey, if I'm farming on, say, Solend or something, maybe I can put that position into ratio and then take out a loan against that and then put more of it into Solend and just kind of leverage up my farming. And so instead of earning like 20%, like I could get it up to like 80 or something like that. And the other really cool part of that was like, it just pays itself back over time. So the longer I do it, the less I have to, the more I have to like redeploy, but like the less I have to worry about my collateralization ratios. So is that what you kind of expect to be a common use case?
Yeah, absolutely. I think the biggest thing that we want to do is to allow people the freedom to take any sort of position that they'd like. Being an LP farm is inherently going long in those two assets, which, impermanent loss, et cetera, it's not always necessarily a good thing. By allowing users to mint that stablecoin against that certain position, you can go onto, for example, a Mango market and go short against those assets too, to really create those delta neutral positions that you were speaking about. And I think that the thing that we're really focused on is also creating a market around risk. We're looking to create quite a bit of financial derivatives based off of the risk that's available in LP farming in general, and just creating a whole new market so that people can trade not just LP positions, but also potential the risk, maybe even creating some sort of convertible bond surrounding these LP notes. Warrants, detachable warrants, for example, is huge, being able to remove some of the APRs from the actual underlying asset and trading that on the open market. We've spoken to a lot of partners to try to get as much, as many options as possible on ratio. So, getting all these different yield farms to allow us to allow our users to basically invest in any yield farm that exists on Solana. Whether that's like a Radium or an Orca or a Saber, et cetera, having kind of one centralized place where users can look at these options that they have and basically create their own risk appetite surrounding their LP positions, creating a portfolio of LPs and being able to hedge that risk away. And using the leverage, that you can take using the USDR, you can do some really cool stuff surrounding that. So, we're working on a couple of other integrations with some major centralized exchanges where users can actually mint USDR on these decentralized exchanges directly. So we're really trying to make sure that the use case for USDR is extremely strong so that there's actual utility to using USDR, right? There's a lot of stablecoins out there, and a lot of these are kind of designed just so that you can print money, and there's not much you can actually do with those stablecoins. But we really want to focus on, one, making sure that the stablecoin is a good representation and has a really strong backing of financial assets. Like Shimon mentioned previously, we have a lot of assets backing this, and using our risk quantification, it's basically risk mitigated stablecoin, which is super exciting. But also making sure that you can use this as the stablecoin in as many different protocols as possible, is key for us. So yeah, to go back to your original point, we really envision the users taking as many types of esoteric positions as possible, and we're really excited to see what comes out of it as well. And then creating more financial derivatives around this risk that exists, and allowing users to really create this new market of trading risk among parties. So yeah, very excited for that.
Yeah, can you talk a bit more about creating liquidity for USDR? That's like historically been kind of the biggest challenge for even Maker is like maintaining. All right, yes, it's mintable for $1, but usually the self-contained vaults kind of make it hard to arbitrage that away. A lot of projects tend to go towards trying to get involved, listed on Curve so that they can get some one-to-one stablecoin liquidity. But yeah, can you talk a little bit more about your approach?
Yeah, so I think that we've been pleasantly surprised with how enthusiastic a lot of different projects like Saber or Mercurial or Aldrin, different AMMs are excited to work with us because we're basically doing the risk assessment for various types of LP for them. Mm-hmm. That's what we're allowing them to do, which bypasses so much headaches for everyone involved, making it an excellent form of collateral that essentially gives different protocols exposure to massive different types of pools that once again are interest bearing. So for those reasons, we think that there's a lot of natural use cases in the open finance space for USDR in general. And further to that, of course, one of the really big successes in projects like Luna and UST is coming up with actual use cases for UST and demand that goes beyond just DeFi, but in their case, e-commerce and commerce in general. So, of course, in the future, as Ratio grows, we're looking at things like payment apps. We're looking at things like creating more external use cases for USDR that allow it to bridge beyond just DeFi, especially as we can start accepting more esoteric forms of collateral, such as ETFs, such as tokenized stocks, different debt instruments, such as the ones that Sam were mentioning earlier. So for all those reasons, we've had already a lot of excitement around using USDR as a form of collateral in Solana. And of course, in the long term, we hope to see it go beyond that. And I think Sam might have something that he wants to add on to that.
Yeah, just quickly on that note as well, is that we've really done our homework. We've spoken with USDC, for example, seeing what makes their stablecoin tick, seeing how, they've maintained all the liquidity for it and all that kind of stuff. We spoke with the guys at MakerDAO. We've really been focused on finding who the best in class have been for every single type of stablecoin and making sure that we understand the principles that drive those stablecoins as well. And then in turn, taking the principles that apply to us and applying that to our stablecoin as well. We're not one of these projects that just wants to push something out quickly and call it a day and move on to the next. We really have put our hearts and souls into this project and making sure that every single detail of every single part of the project has been thought about 1,000 different times by 1,000 different people, to really ensure that what we're doing is creating lasting value, not just for us, but also for everybody else involved in the DeFi space. We want to contribute value to the ecosystem as a whole, and that's also why we've been so focused on partnering with as many different people as possible. Because our vision isn't just that DeFi is here for today and gone tomorrow. We really think that this is going to be instrumental going forward in reducing the wealth gap, for example, and also just giving people access to these financial derivatives and financial options that are extremely difficult to get in the traditional world, just given all the barriers that have been put in place. So we really do want to create open finance, and every single step of the way, we've really made sure that everything's fully thought out and has been and is created in a way that just creates a lot of value for everybody involved.
Got it. So where's Ratio at now? Is it something that we could use today, or what stage is it at?
Yeah, that's a great question. Right now, we're actually in our incentivized testnet phase. So if there's anyone here that's interested in that, you can, go to our Twitter. I think that if you follow DeFi Nation on Twitter as well, you can find us there. And you can sign up to take a short quiz, which will also give you the opportunity to learn more about Ratio and get a slot in our incentivized testnet. We have some really, really exciting news coming in the next week or so, which has a direct path towards mainnet. So we think that it's an exciting time to get involved with what we're doing and potentially get a slot in being one of the first users to give us feedback and help us improve the protocol. So that's where we are. So stay tuned.
Cool. Yeah, I'll make sure to drop a link to that in the show notes. What else is next for you guys beyond that? What's on your roadmap for the rest of the year?
So there's a couple of things. The first thing obviously is getting to mainnet. From there, we're looking to add new types of collateral that's available. Making sure that we're creating some new financial derivatives as well. The one thing that we're also very excited about is developing out our risk API, which is basically the quantitative risk assessment that we do, but then allowing that to be plugged into every single DeFi protocol that exists. Right, that's kind of been our main aim, is to be a Moody of sorts for DeFi, where we do the assessment of these assets for different protocols and allow them to use that. One thing that's also pretty interesting is that we've spoken with quite a bit of traditional players that are trying to get involved in DeFi, and especially yield farming, but DeFi in general. But the biggest barrier to entry for them has been getting this risk data. It's been quite difficult for them to do that. So we're working with them very closely to try to get them involved in DeFi, which I think would be great for everybody, because there's a lot of money waiting on the sidelines right now trying to get in. So we're really trying to de-risk DeFi for bigger institutions. I think it would be great for them to get involved. I think it will legitimize the space a lot too. And also just for the retail investor, trying to get the everyday mom and dad or whatever who's trying to just make, some good profit on yield farming involved, and allowing them to not be scared of DeFi, not be scared of these words that they've never heard, and making it very explainable for them. And also just showing them what the risks are of taking this. We've spoken to people in the past too, and we've used protocols too in the past where they tend to shy away from the risk and try to hide it, because risk is scary, and if people know how risky certain things are, they don't want to use it. But I think that us taking the opposite approach and being extremely transparent about the risk of certain positions that you take will really attract more users and allow them to be more comfortable going forward. So that's what's in the roadmap for us right now. Sharon, I don't know if there's anything you want to add to that.
Yeah, just a quick thought is that as our risk assessment improves, that will also have a synergistic effect with de-risking DeFi as a whole, right? Because if more people are building risk assessment into their protocols through us, that will also help them see which LP pools are inherently riskier, which types of collateral are riskier. It will help their users make more informed decisions. And it may also have the effect of clearing out bad actors or malicious products, which the average user won't be able to see is a rug from a technical perspective, right? So many of these projects that rug their users, they have great influencers, they have great marketing, it looks shiny, huge APR, right? That's one of the reasons that Sam and I started Ratio, is because we didn't know that much about DeFi. And oh my God, man, I think we lost like 300 BNB or something back when it was super cheap, and afterwards we did our homework and realized that we were just throwing our money away, that we were just like actively making other people richer, right? So we really also hope that the risk assessment that we're doing will help push DeFi forward as a whole. And really, we are committed to de-risking DeFi in that sense.
Yeah, it sounds like you guys almost become like risk data as a service, or like a risk oracle of some sort. I wonder if you guys have spoken with Switchboard at all, or if there's any potential collaboration there.
We spoke with Chain quite extensively as well. Some interesting stuff in the works there as well. But yeah, that's definitely where our minds are at.
Cool. Very interesting. Is there anything else that you think everyone should know? Anything I didn't cover? Anything we didn't go over?
Well, Happy New Year to everyone. And if you want to learn more about us, you can follow us on Twitter, read our Medium. As we said, we have an incentivized testnet going on right now. Really big announcements coming in the next few days, kick off the year in a really nice way. And yeah, please feel free to jump into our Discord, our Telegram. Our community managers are very responsive. And if you're another protocol that's building on Solana that's interested in building risk assessment into what you're doing, or accepting USDR as a form of collateral, please reach out to us as well.
Yeah, I just want to thank you for having us on. Thank you for having us. Let us do our little de-risking spiel. We're, as you can probably tell, we're pretty passionate about this. Like Shimon mentioned, we did get rugged several times ourselves, and there's nothing more painful than waking up in the morning and seeing that kind of stuff happen. So we really hope that nobody has to feel our pain, once Ratio is fully live. But yeah, no, thank you again for having us on. It was a great conversation. We enjoyed being here. Yeah.
One final question. How does one increase their chance of being able to participate in the incentivized testnet?
Provide, quality feedback. As in, take bot, basically. Yeah,
What's don't that?
Be a bot.
Don't be a bot.
There's a lot of bots that answer our questionnaires, trying to get in, and it's very clear if you're a bot or not. So if you give a nice, thoughtful answer, I'm sure it makes your life a lot easier to get picked.
Definitely.
Got it. Don't be a bot. Don't be an NPC.
Exactly.
Get involved with the community.
Life advice. Yeah, exactly.
As well. All right. Cool, guys. Very good to chat with you. Looking forward to this. Looking forward to use it. And yeah, Happy New Year.
Happy New Year.
Thank you.
Thanks, Tom. Bye, DeFi Nation.
Bye.
Bye.